Mr. Sanjeev Prasad, who's the MD and co-head at Kotak Institutional Equities, joining us on the show to exactly dissect that for all of our viewers. A very good morning to you, Mr. Prasad. Thank you so much for joining us on ET Now. And very interesting note that you've come out with, and the title says the price value flows and cats alive or dead. What's your take on the markets right now? Which side of the fence are we in?
You'll see this market, when you say it's a very loose term here, when you talk about market, I assume you're talking about the Nifty 50 index or any of the large cap index. So it looks okay, I would say. But on a top-down basis, Nifty 50 index does not look very expensive, about 19 times on the one-year forward basis, so that's fine. But the problem is if you dissect the index a little more, then you realize that there is not much value in most parts of the large cap index, mid cap, small cap, whichever way you want to cut it. The problem is if you look at Nifty 50 index as an example, it is looking reasonable given the fact that you have a large number of low PE companies in the Nifty 50 index, and who have and those companies have a fairly large weight in terms of contribution to profits of the Nifty 50 index. For example, if you look at the breakdown of profits, you have something like almost 40% of the profits coming from very low PE companies. The average PE is about 10. And Nifty 50, for example, has companies ranging from 6-7 PE, which are Coal India, ONGC, etc., to all the way to a Trent, which is more than 80 PE. So I don't even know what sense does it make to look at an index level anyway, or for that matter, the market. Ultimately, you have to look at every stock on a bottom-up basis to figure out whether there is value in the stock or not.
Right. So like you said, that given the fact that we've seen a very sharp correction, but you're not seeing value in the markets, some of the pockets that you can name where actually, despite the sharp corrections that we have seen, you're not seeing actually value, or it's something that you will not go ahead and park in your monies right now?
That's pretty much most parts of the market, to be honest with you. If we start with the consumer staple names as an example, most of the names are at 45 to 60 PE on a one-year forward basis. Now, if you look at the growth profile of these companies, they have come down dramatically compared to, let's say, high single digit and low double digit kind of high single digit volume growth and low double digit or mid-teens top line growth that they were doing before the pandemic. Now, many of the companies are struggling with low single digit volume growth and mid single digit top line growth. So, what is the rationale of giving similar higher multiples for companies which are growing much slower in the, let's say, in the next 1 or 2 years? And more important, also seeing a lot of disruption to the business model because of more competition coming in just about every category of consumer staples. So I don't know. I mean, somehow the market seems to be more focused on prices rather than looking at the price value proposition across stocks. I mean, just because the stock is corrected doesn't mean anything in isolation, right? Has it correct to the right level in terms of value? That's the question to ask.
Hi Sanjeev, this is Shrishti also joining in. If you can share your view on the banking space, because a lot's been changing for the overall financial space as a whole. What we are seeing is that the liquidity situation is seen to be improving a bit. Other than that, the regulatory steps are also coming in the favor. We are talking about MFIs now having come out of the stress that they were witnessing for the past quarters. Give us a sense that how are you looking at the banking space, and where is that the investors can find opportunity? Is it that in some of those large caps which are better placed right now, or some of those beaten down names which have seen sharper corrections, maybe of 50 or 40% from their highs?
Banking is one of the few sectors where there's value, I would say. There are some short-term headwinds in the form of high NPLs in a portion of the loan book, which is the MFI loan book and the personal unsecured credit loan book of the banks. In particular, banks have a lot more exposure to the MFI loan book, small finance banks as an example, and the MFI NBFCs, of course. Hopefully, we are getting to the end of that problem, although I suspect it could be another 1 or 2 quarters before we start seeing some stability on that count. But other than that, the good part is that we are not seeing any real increase in stress as far as the secured loan book of banks are concerned. It is pretty much across large cap, mid cap, small cap banks and NBFCs, etc. Now, coming to the valuation part, it depends on what is your risk profile. If you are a somewhat risk-averse investor, it probably makes sense to be in the large cap banks, which are again trading at reasonable valuations. For example, ICICI Bank, if you look at currently, if you take out the value of the non-bank businesses, it's about 2.4, 2.5 times on the one-year forward price to book. It's a bank which is doing everything right, whether it is credit growth, deposit growth, NPLs, everything is absolutely fine over there. So even if the bank does not see any rating from here, you're still looking at a 15, 16% ROE linked return over a period of time, per annum, I should say. Similarly, then you have the next set of banks, we are seeing some challenges on growth. For example, HDFC Bank, given its liability, asset mismatch currently. But from FY 2027, the bank should again start growing quite reasonably. It's already priced in. The bank is trading at about 2 times price to book. Again, if you take out the value of the non-bank businesses, hopefully you could see some rating as the growth starts coming back in a year's time or so. If you are willing to take some more risk, then you could look at some of the banks which have beaten down quite significantly, like the Bandhan Bank or IndusInd. Of course, there will be headwinds in the next 1 or 2 quarters, given the fact that the banks have reasonably high exposure to the FI category. But both of them are down to 1 time, price to book. So hopefully a lot of that bad news is priced in. The other part of your question, yeah, it seems like, there is more, focus on reviving growth. That is why you're seeing, a lot more focus on increased liquidity in the banking system. And of course, at this point in time, inflation looks like it's coming under control. So the RBI can focus more on the growth aspect and, improve the liquidity deficit, which has been there in the banking system for a period of time. Also, some of the rollbacks on tighter oversight, which were there on the banks, that should hopefully help the banks take more risk as we go along, and hopefully credit growth starts looking up compared to 11% growth, which was there as of the end of December 2024.
Sanjeev, very interesting. I was going through your note, and given the fact that the interesting take over there, the headline says, "Does a dead cat really bounce?" And in that, you've spoken about the narrative stocks. And you've given a rationale, given the fact that these narrative stocks, given the fact that they've fallen from those elevated levels, they don't seem that attractive right now. And there are some reasons that you've given that one must take note of. One, the cat may be already dead. The cat will be dead if it's already dropped from a sufficient height, despite the fabled cat's 9 lives. And lastly, you said the image will be too ghastly to imagine. So it's very interesting, but I want to understand your rationale and why.
We're just talking about, a lot of stocks which had gone up for no rhyme or reason. Many of them are trading at several times book value without really any great business model. Some of them are even making losses, no real prospects. Look at the valuation of this company. I'm not taking names over here. It's all there in the report. Many of these are trading at 8, 10 times price to book. I mean, for what exactly? Many of them are not even generating any profits at this point in time. The multiples are at, look at from a PE basis, there are some companies which are trading at, 70, 80 P. And these are not companies which are growing at some, very ridiculous growth rates that you can justify that kind of P. So what's the logic of, giving such multiples for these companies? I have no idea, to be honest with you. So these stocks need to correct a lot more. The fair values of this company are significantly lower than where the current prices are, despite the 30, 50, 60% correction that you have seen in this stocks. Let me not say too much about it, but I have my own views on why the stocks have gone up so much and why they are correcting so much now.
In this market, the other question that one is grappling with also is whether the same leadership will make a comeback or not. Do you now need to sort of, shuffle your portfolio strategy? And more importantly, critically, is what to avoid next?
I would think at this point in time, you should be focused more on preserving capital rather than trying to find too many ideas in the market. As I was saying earlier, there is not really too much value in the market beyond the financial space, to some extent, healthcare, pharmaceuticals, although even there you are seeing some challenges because of those, potential imposition of import tariffs by the US. If they do that on generic imports from the US or from India to the US, obviously, you will see a lot of challenges for the US generic dominated Indian companies. Beyond that, across sectors, we'll find 1 or 2 names, but that's about it. It's not a market which is, which has a lot of value for sure. I mean, people have forgotten the fact that, if simply you do a, look at the valuation, current valuations versus where the stocks used to be 4 or 5 years back, let's say before the pandemic, in most cases, multiples are still, higher or similar compared to where they were before the pandemic. And in most cases, the growth numbers are looking a lot more challenged as of now. So that's the whole problem. I don't know why the market seems to be so obsessed with, prices and flows rather than looking at ultimately the price value proposition every stock.
So good to have you today on the show. Thank you so much for your time.
My pleasure. Thank you. Bye.
Right. Okay, that's the word coming in from none other than Sanjeev Prasad, saying that be watchful in this market. Don't be in a hurry to try and buy that dip. The only island of safety seems to be financials. And yeah, steer clear. There's no harm in preserving capital. That's the word coming in from the House of Kotak.
If you like this video, then like, share and subscribe to ET Now.